Welcome to the next episode of the Audit Practically series. So, a new day, new video. So, we're going to be seeing something that's really different today. We're going to be doing a lot of number crunching today. So, we're going to be looking at how do you look at impairment as an auditor of an entity. So, let's discuss the case right away and let's move on to the series, right? Yeah. So, first, let's say KPMG is the auditor of XYZ Limited. Let's say XYZ Limited has 95% stake in ABC Limited, which is shown in XYZ Limited standalone or separate financial statements at, let's say, 300 crores cost. So basically what would happen is XYZ Limited in its standalone or separate financial statements would show a line item as investment in ABC Limited to the extent of 300 crores. I hope that is clear. Let's say PwC is the auditor of ABC Limited. Let us say XYZ Limited, while looking at the investment, they understand that there is an indicator for impairment in the investment, due to which they proceed with the impairment testing. So guys, I would suggest you all to refresh your knowledge of Ind AS 36 or AS 28, preferably Ind AS 36, because we will be looking at these things from Ind AS perspective, because we will be touching upon a lot of aspects of Ind AS 36 impairment today. But no worries, I will also give you a brief introduction before we move on so that you're able to refresh your memory about the same. But in case you feel completely blanked out, go back, revise Ind AS 36 and come back here. That would be really better, right? So let's say what is happening is XYZ Limited management understands that there is an indicator for impairment in the investment made in ABC Limited. So what XYZ Limited's management need to do right now is they need to actually evaluate whether the 300 crore of investment that is shown in ABC Limited is actually worth 300 crore. Is the 300 crore actually reflective of the value, or is it something like 200 crore or 280 crore or 250 crore? That is there a reduction in the value of the investment required, which would trigger an impairment charge in the books of accounts? This is really important, guys, because this would have a direct P&L impact, and the number is not small. The number would be a big number on the profit and loss account. So this is usually an area that is assigned to experienced people, preferably CS with good experience. By God's grace, I got the opportunity to do impairment testing even just in my second year of articleship. So I'm going to share the knowledge I gained during this process by taking you through a full-fledged work paper. And guys, I'm going to attach this work paper right there in the description of the video and also in our Telegram group so that you're able to even use this as a ready referencer while doing your audit. So this is a proper work paper which will be of real value to guys. So sit back, relax, and enjoy as we deep dive into this. So basically, guys, just to give you a recap about Ind AS 36, Ind AS 36 basically talks about one major term, recoverable amount. So recoverable amount is basically the higher of fair value less cost of disposal or value in use, whichever is higher. Guys, what is fair value less cost of disposal? So fair value less cost of disposal is basically fair value which is computed in accordance with Ind AS 113 plus cost of disposal. That is the cost which is required to dispose of the investment, that is in our case is referred as cost of disposal. So it is basically fair value minus cost of disposal or value in use, whichever is higher. Value in use refers to the value which is derived from the continuous use of the asset throughout the life of the asset by using discounted cash flow approach. Because Ind AS 36 clearly states that for the purpose of computing value in use, you need to use discounted cash flow approach. So let's take a basic numerical example, right? Let's say my value in use is 100 and my fair value less cost of disposal comes out to, let's say, 80, and let's say my carrying amount. So basically, what is carrying amount, guys? Carrying amount is basically the amount that is shown in the books of accounts or in the financial statements. So in our case, carrying amount is basically 300 crores, which we just discussed just now. Okay. So carrying amount, if I have to give you a perspective, let's say carrying amount comes to something like 120. So here the recoverable amount would be 100 because here in the case value in use is more than the fair value less cost of disposal, and carrying amount is 120. Since the carrying amount is greater than the recoverable amount, carrying amount is actually not, so the asset is not worth 120. So the asset is only worth 100 because the recoverable amount is only 100. So in this case, the impairment charge that would be required is 120 minus 100, 20. So that is what we are going to be discussing, guys. So basically what we will be discussing today is how do we compute this number called value in use? How do you use the discounted cash flow approach to compute this? How, as an auditor, do we need to get comfort on the discounted cash flow approach? What are the assumptions that are going to be used in the discounted cash flow approach? And how, as auditors, do we get comfort over this? How, as auditors, do we verify this? How, as auditors, do we assess the reasonableness of this? So this is what we're going to be looking at today. It's going to be a very, very interesting session, guys. Brace yourselves up, be vigilant, and pay complete attention because this is going to be a very, very insightful session, a technical session. Don't miss out anywhere. Stay throughout the session, stay connected with me. Don't lose sync anywhere, right? Cheers. Moving on to the session, guys. Yep. So basically what we are doing is we are first going to be looking at the balance sheet and P&L of ABC Limited. So we are the auditors of XYZ Limited. That is, we are KPMG. We are going to be looking at the balance sheet and P&L of ABC Limited. So let us look at the balance sheet and P&L of ABC Limited, and then we'll project the balance sheet for the next 5 years. We'll project the P&L for the next 5 years. We'll see how the management has projected the balance sheet and P&L for the next 5 years, and we will go through the projected balance sheet and projected P&L and assess the reasonableness of the same, and then we will prepare the projected cash flow statement for the 5 years also. So just follow me on this, guys. So now you might not be very clear on what is happening, but once you start following me, once you start listening carefully to me, you will get a good grip of things at the end of this. I assure you that sometimes it might look unclear to you, but at the end of this lecture, I assure you, you will have great clarity. Just listen to me, just stay invested here, right? Yeah. So basically, guys, what we are going to be seeing is, so this is the balance sheet of ABC Limited. So basically what XYZ Limited will be seeing is, XYZ Limited has an investment worth 300 crores in ABC Limited, and the stake XYZ Limited holds in ABC Limited is 95%. It's not a wholly owned subsidiary. Just keep this in mind. This we will connect in the later part of our discussion. This is very important. XYZ Limited holds 95% stake in ABC Limited. Just remember this for now. And what XYZ Limited is basically doing now is, they have asked the management of ABC Limited, they've called up ABC Limited and said, sir, we want your balance sheet and P&L, sir, for financial year 24-25. Why do we want this, sir? Because we want to project the numbers for the next 5 years. Or what they might also do is, they might ask ABC Limited, sir, you would have also projected numbers. It would be great if you are able to give us the numbers, because ABC Limited would have better knowledge of their business compared to the management of XYZ Limited, right? So what XYZ Limited will do is, they will call up the management of ABC Limited and say, sir, you would have projected the numbers for the next 5 years, right? Please give us the projections. And we will have to provide that to the auditors of XYZ Limited, that is KPMG, because they want to assess whether there is an impairment required for the investment or not. First of all, before they assess, we will assess it. We will assess whether an impairment is required or not. We will do the workings and we will give it to KPMG. KPMG will reperform the workings. KPMG will go through the workings, and they will also come up to us with any queries, and they will also reevaluate whether an impairment is required or not. So that is basically the scenario, guys, to give you a perspective. Yeah. So okay, let's move on. So this is the balance sheet of ABC Limited, which the management of ABC Limited has given to the management of XYZ Limited, which in turn the management of XYZ Limited has given to us, the auditors, that is KPMG. So this is the PP, capital work in progress, intangible assets, financial assets. So all your items are here. So what we need to do is, these projections have also been given by the management to us. What we ultimately need to do is, we need to get comfort over all the numbers here. So basically, guys, before we just move on, I just want to tell you that there are some numbers which are very immaterial here. Before that, let's look at the balance sheet size here. If you see here, the total assets are rupees 650 crores. Everything is in crores. The total assets are 650 crores for financial as at March 2025. And the total liabilities should also be 650 crores. Yes, they are 650 crores. And the balance sheet is time bound. No concerns. Basically, if you see, the balance sheet size is 650 crores. If you see some items here, I've highlighted them in green. Why have I highlighted them in green, sir? Look at the value of these items. Like financial assets is 2 crores, loan 9 crores, other financial assets 7 crores, financial assets 2 crores, investment 7 crores. And next, if I come to something like other current assets 1 crore, other financial assets 5 crores. So if you see these items which are highlighted in green, look at the value of these items. Like if I have to come here, 33 crores. These items are not even 10% of the total balance sheet size. The total balance sheet size is 650 crores, right? If I apply 10% on it, it's 65 crores. This is only 33 crores. So what we have assumed is that we have assumed these items to be constant for the 5 years of projection, because these items are not even significant. We actually, in terms of projections, guys, let me tell you, we need to spend time, we need to invest a lot of time on items that are very big in nature. For example, property, plant and equipment, working capital, and we need to spend a lot of time on revenue and cost of goods sold, because these are high bucket items. These are big bucket items. We need to tackle these items first. We can't keep spending our time on items that are trivial, like our financial assets or loans, which are very, very small in amount. We need to take a call and move on, because we are going to be analyzing them. We are not going to be like digging into these smaller numbers. We can't spend time on these smaller numbers. I hope you understood the perspective, guys. And so what we have done is, these smaller numbers like financial assets, loans, other financial assets, we've kept them constant for the next 5 years of projections. If you see, we have retained the same number, and wherever we have kept the same constant, we have highlighted them in green. Like other current assets have been kept constant. Like if I come to the liability side now, share capital has been kept constant, assuming that the entity is not going to be issuing any additional equity shares. So it is kept constant. Next, if I come to my financial liabilities are only 2 crores out of a total balance sheet size of 650 crores. Again, it's been kept constant. Provisions have also been kept constant. Next, if I come to financial liabilities are also only 3 crores out of a balance sheet size of 650 crores. Again, this is also been kept constant. Next, if I come to my other financial liabilities, again, this is also been kept constant. My other current liabilities, these have also been kept constant, because again, it's only 1 crore out of a balance sheet size of 650 crores. So guys, the heart of our discussion is going to involve around 4 items. Just keep this in mind: revenue, cost of goods sold, working capital changes, and fixed asset schedule. these 4 items are going to be the heart of our discussion. And in any financial projection you see, these 4 items are going to be the heart of that discussion. And maybe borrowings might be the heart of the discussion if the entity has borrowings. In our case, we are assuming that in our hypothetical balance sheet, ABC Limited does not have any borrowings. So, but if you want me to explain to you on how we project for borrowings also, do comment that down below, and I will definitely make sure that I do a separate video on that. For now, we are assuming that ABC Limited does not have any borrowings, which is why I've kept the value of borrowings as 0. So moving on to the discussion, guys. Now let's look at the P&L. Let's get a fair idea of the P&L. So P&L, basically there is revenue from operations, other income, and my cost of materials consumed. Stock in trade purchase is 0. Then my changes in inventory is there. Employee benefit expense is there. Finance cost is 0 because, as we had already discussed, the entity does not have any borrowings and no right of use asset and no lease liability as well. Then depreciation and amortization expenses again 25 crores. Other expenses are 10 crores. So I have my total expenses, my profit before tax, which is basically total income minus total expenses. My tax expense, I don't have a deferred tax. We are assuming that we don't have any deferred tax here. Ideally, every entity will have deferred tax, guys. But since this is a hypothetical case, this is a hypothetical balance sheet and P&L which I've drawn up, I've assumed there is no deferred tax for simplicity purposes, and the current tax charge comes out to 25 crores. So the profit after tax is profit before tax minus tax expense, which comes out to 50 crores. I hope it is very clear, guys. First, let us look at how the entity has projected the revenue numbers and how, as auditors, we need to get comfort over these numbers, guys. Yeah, let's move on to the discussion, right? Yeah, first let's move on to the revenue numbers. If you see for financial year 24-25, the revenue which ABC Limited has earned is rupees 500 crores. Now let me come to the revenue assumptions. So basically, guys, keep in mind that whenever we are assuming we are projecting a number or we are trying to get comfort over the projections of a number, we will discuss that with the management of XYZ Limited, the management of ABC Limited, also the auditors of ABC Limited, PwC, because they would have more idea about ABC Limited than we have, because they are actually doing the audit of ABC Limited. We are only doing the audit of XYZ Limited, and at the consolidated financial statements, we would be looking at ABC Limited to a decent extent, but not as much as PwC would be looking into it. So we would look to interact with the auditors of ABC Limited also, that is PwC, and get an understanding of the business from them also, and get an understanding of the reasonableness of the projections from them also, from the management also, so that we are able to get more comfort. And you will also be looking up at industry reports, published reports, and look at the reasonableness of the numbers that the management has taken in the projections. I hope that is clear, guys. Let us say in the industry in which ABC Limited operates, the total demand expected in the first year of projection is 50 million units, right? So we trace this to a published report. And let us say the industry is expected to grow by 8% year on year. I hope that is clear. Let us say ABC in the industry has a market share of 5.5%, right? Okay. And let us say the market share is expected to be stable. In the sense, it is going to be 5.5% of the total market size every year. Because let's say entry and exit are regulated in this industry and it is not easy. So we are presuming that ABC is expected to maintain its market share as it is. And let's say the average selling price comes out to rupees 2,000 per unit. How do we get comfort over the average selling prices, auditors, guys? We can look at the sales registers of the last few years, and we can find the total sales number by the units sold. Assuming that we take products with a similar sales mix, in the sense, like, let's say all these pertain to the same product. That is how we arrive at this. I hope that is clear, guys. And let us say we also look at the open sale orders. Like, let us say, like, financial year 24-25 got completed for ABC Limited and the audit got over. But let us say for financial year 25-26 also, entity ABC would have entered into sale contracts, right? In those sale orders, they would have fixed prices with their customers. We look at those prices also and we get to a conclusion that, okay, this is also somewhere close to 2,000 per unit, and we get comfort over that. Hope that is clear. And let's say the price year on year is expected to grow by 2%, because let us say ABC's limited suppliers are increasing the price 2% year on year in relation to raw materials. And obviously, when an entity's input costs increase, the entity is going to pass on that cost to its customers. Very obvious, right? Yes. So that is what entity ABC is also doing in this case, right? Yeah. Let's just come down. Let's see the market size. Let's compute the market size. So we understood that in year one, it was 50 million units. And as we had discussed, we expected the industry to grow by 8%. So 50 into 50 plus 8%, 54. And 54 plus 8%, 58. 58 plus 8%, 63. 63 plus 8%, 68. So this is the industry size year on year: 50 million units, 54 million units, 58 million units, 63 million units, and 68 million units. Out of this, ABC Limited has a market share of 5.5%. So basically, to find out the number of units which ABC would most likely sell in each of these 5 years, we would need to take the market size, which is 50 million units, into 5.5%, and 54 into 5.5%, 58, 63, 68 into 5.5%, and derive the number of units that ABC Limited is expected to sell in each of these 5 years. I hope that is very clear, guys. So these are in millions, okay? Yeah. And average selling price, as we had discussed, we are expecting it to rise by 2% year on year based on the increase in input costs. So 2000 plus 2%, 2040 plus 2%, 2081 plus 2%, 2122 plus 2%, 2165. I hope that is clear, guys. Now, basically, to find out the revenue, what do? We know the number of units sold. We know the price per unit. Basically, number of units sold into price per unit would give the revenue for each of the projected years. I hope that is very clear. That's what we've done below. 2.75 million units into 2000 per unit. We get a number that is in millions. But as you remember, our balance sheet and P&L were in crores. So 10 million is equal to 1 crore. So to derive this number in crores, we basically divide by 10, which is what we have done here. So for year 1, the revenue is 550 crores. Year 2, it's 606 crores. Year 3, it's 667 crores. Year 4, it is 735 crores. Year 5, it is 810 crores. I hope that's very clear, guys. I hope you got an understanding. And when we come to our P&L, we have linked the numbers here. 550 is linked from here. This is also linked. This is also linked. This is also linked. This is also linked. So once we complete each of the numbers, I'll just be highlighting them, saying that we have completed them for our control check, right? So basically, guys, when we do projections for any entity, it is better to link every single number rather than manually keying in, because when you manually key in, there are a lot of chances that you lose control over the numbers and you end up going wrong. So it's better that you have a track by linking all the numbers, which is what we've done now. I hope that is clear, guys. So revenue is tackled, done and dusted. Okay, now let's come to cost of goods sold. Before we come to cost of goods sold, we see that there is an other income of 20. We see that this is more like a recurring item. Like, let's say there is a recurring nature of item, like maybe forex gain or loss, which is sitting here. Maybe there is a forex gain which is sitting here, and we expect the same to be continuing year on year, because the amount is also not material, guys. Again, if you see, the top line is 500 crores, out of which, and the other income is only 20 crores. Like, if you see the other income as a percentage of the total income earned by the entity, it's very, very minuscule. In the sense, it's how much percentage? It's only 4%. So you can just assume it to be constant, as we had assumed for some of the balance sheet items, and move on in life. That's what we're doing here. I hope that is clear. Now let's have a look at cost of goods sold, guys. Cost of goods sold, if you see, is the sum total of these three items: cost of materials consumed, purchases of stock in trade, and changes in inventory of finished goods, work in progress, and stock in trade. I hope that is clear, guys. So basically what is happening is, if you see the cost of goods sold for financial year 24-25, it is 365 crores. I hope that is clear. Now what we're going to be doing, guys, we need to find the cost of goods sold for the next 5 years of projections. What is basically cost of goods sold? How do we compute cost of goods sold numerically? If you have to put it here, number of units sold into cost per unit. Am I right, sir? Yes, sir, you're right, sir. Where do we get the number of units sold, sir? We already derived that, sir. So we have that ready. What do we need to find now? What is our area of concern right now? Cost per unit. We just need to find the cost per unit, which is our area of concern. How do we find that, sir? Okay, let's move to the next step and let's start discussing that, right? Yeah. So basically, again, guys, for cost of goods sold, we will go back to the management of ABC Limited. We will discuss with them. We will get an understanding of what is roughly the cost per unit. Okay. How do we get an understanding of this, guys? So there is something called a bill of material. Bill of material basically is a document which in inventory terms states that how much material is required, how much labor is required, how much overheads are required to manufacture a finished product. So basically we get from the inventory team or the costing team of ABC Limited the bill of material and get an understanding that, okay, 60% of the cost is in relation to material and 40% is in relation to labor and overheads. And for the material cost, we trace the material cost to the purchase orders. Like, let us say, as we had already discussed, for the financial year 25-26 also, ABC Limited would have started entering into contracts with its suppliers to purchase raw materials, right? So we trace the raw material prices back there, and we also look at the past trends, and we get an understanding that, okay, on an average, the raw material cost has been around 960 per unit, like average price that ABC Limited has entered into with its suppliers to purchase raw material is at rupees 960 per unit in financial year 25-26. And as we had discussed, we expected the price to increase by 2% year on year. So if you see the total cost of the material here, it is 1,600, out of which 60% would be raw material, which we understood from the bill of material, and 40% would be labor and overheads. Basically, this price is expected to increase 2% year on year, as we had already discussed earlier, which we as an entity had ultimately passed on to our suppliers. So 1,600 plus 2%, 1,632 plus 2%, 1,665 plus 2%, 1,698 plus 2%, and thereby leading to this number. So basically what is happening is we have derived the cost per unit basis the bill of material looked into, basis the last previous year's costing workings looked into, basis the purchase order prices looked into, And we understand that, okay, 2.75 million units are sold. So 2.75 million units into rupees 1,600 per unit would give me the numbers of cost of goods sold in million. But I need it in crores, which is why I divide by 10, similar to how we did above. So we get 440 crores, 485 crores, 534 crores, 580 crores, and 648 crores. Let's look at what we have taken in our P&L. We have taken 440 crores, perfect. 485, 534, 588, 648, perfect, sir. Everything is linked. Yes, that is the power of linking, guys. You don't miss out on items. You can do a control check very easily. And guys, we are not bifurcating this into cost of materials consumed and changes in inventories, because we're not looking at a schedule 3 finances, guys. We are looking at it from a bird's eye view, from a projection standpoint. So we don't need to align everything to schedule 3. I hope that is very clear, guys. Yep. Okay. So this is done and dusted, guys. Next. Okay, this is also done and dusted inherently, because again, this is the total number of COGS here. So this is also done. Changes in inventory is also done. Employee benefit expenses. Yes, employee benefit expenses. ABC Limited is actually a manufacturing concern. So it is not a service concern. So if you look here also, employee benefit expense is not very large. In the sense, if you look at it as a percentage of turnover, I think it's around maybe not even 10% of turnover. It's not a very significant number. Usually, how do we project employee benefit expenses, guys? Basically, an entity would basically take the total employee cost divided by number of employees. This would give us the, divided by number of employees. So this would give us the average salary cost per employee, right? And on that average salary cost per employee, let's say 100 comes as the average salary cost per employee, you would for the next few years, let's say, apply the salary escalation rate. Let's say 8% is the salary escalation rate. For the next year, the average salary per employee would be 108. This you would multiply with the number of employees. Let's say 2,000 employees are expected in the company. You would multiply this and you would arrive at the number. But for simplicity purposes, considering that this amount is not material, what we have understood is, we have understood from the entity that the salary escalation comes out to 8% year on year, and we have applied it directly on the number instead of like dividing it by the number of employees, average salary, like factoring in the headcount. Because what we understood from the management after discussing is that headcount is not expected to significantly change. Like we discussed with the HR also of ABC Limited, and we understood that, okay, the manpower count is also not expected to change significantly. It is going to be in line with the previous years. We got an understanding in that sense, and we take this. How do you get comfort over the escalation rate, guys? So escalation rate, basically, if you can compare that with the escalation rate by companies in similar industries, and you can get comfort over the escalation rate that has been used. That is one way to get comfort over the escalation rate. Another way is, you can look at the trend that ABC Limited has seen in the past few years. Let's say they have consistently been giving a salary increment of 7 to 8% every year. This also seems very reasonable. I mean, this is reasonable and you can go ahead with it. But let's say ABC Limited only gives a salary escalation of like 5%, 6% in the past, and suddenly they come up with a number of 8%. It is not wrong. It is not impossible that an escalation of 8% would not be achieved. But you need to get an understanding from the management on how they plan to achieve the salary escalation of 8%. I hope that is clear. And if their plan is justified, you can definitely go ahead and consider that in your projections. So employee benefit expenses are also done and dusted, guys. Okay. Next, let's come to finance costs. Finance costs are nil because we don't have any borrowings and we don't have any lease liability, as we had already discussed. Okay, guys. Depreciation amortization, we will be looking at this as a part of our capex schedule. We'll be looking at this along with PP. So let's just park this aside for now. Let's move on to other expenses now. Guys, from what we discussed with the management, we are able to see that other expenses are 10 crores. But basis our discussions with the management, we understand that out of this 10 crores, 9 crores actually pertains to royalty. So only 1 crore is the other expense items, right? 9 crore pertains to royalty. And royalty is expressed as a percentage of sales. So royalty is a percentage of sales, is what we understood from the management. So we see here, almost 90% of the other expenses is ideally a percentage of sales. If I translate my other expense as a percentage of sales, 10 by 500, we basically other expenses are like almost 2% of sales. So what we will basically do is, every year, whatever sale we have into 2%, we will apply that and we'll derive our other expense number, because the remaining component of other expense is not at all material. I hope you understood this, guys. If you see for the first year of projection, it's basically 550 crores into 2%, 606 crores into 2%, and so on. That's what we have done. I hope it's clear. You can again see these formulae, guys, when after this video is over, you can again rework this file also if you want to. You can go through this file, because I'm providing you this file also for absolutely free, so don't worry about that. So this is how we get a comfort over other expenses also, guys. But let us say there are other numbers also. Like let us say there are other major expenses, like maybe consumption of stores and spares is there, or maybe your rates and taxes are there to a significant extent, or maybe your repairs and maintenance is there to a significant extent. Then you need to understand it line by line. You need to do a deep dive and understand. Maybe if you want me to do a video on what other possible items of operating expenses could be there and how do we project for them, you can comment down below. I will also cover that in a separate video, right? Yeah. For now, this is it, guys. So our P&L is also sorted, guys, except for depreciation and amortization, which we said that we would revisit in a while. So current tax. So current tax, basically, if you see, we understand from the entity that the tax rate applicable to the entity is 25.17% because the entity is in an alternate tax regime. So basis that what we do is we take the profit before tax number and we multiply that with 25%, which will lead me the tax rate. So 43 crores into 25%, which will give me a tax charge of 11 crores. Again, we are assuming a deferred tax of 0 for theoretical discussion purposes alone, but practically this is not how it works. So we have derived the number. But if you see here, guys, the effective tax rate in financial year 24-25 was 33% because we had a current tax charge of 25 crores on a profit of 75 crores. But what happened was we understood from our discussions with the management that this was a one-off item due to which the current tax charge had significantly increased. Maybe let's say there was a capital gain or something due to which the current tax charge had significantly increased in that financial year. But we are not expecting such one-off items in the next 5 years of projection, due to which the management expects the tax rate to be in line with the statutory rate. So which is what we have assumed here, and which is how we have gone ahead. Like we have taken the profit before tax, multiplied it with the tax rate, and derived the number. So this is how we have done that. I hope this is clear, guys. Yeah, cool, perfect. So I hope this understanding is clear, guys. So our P&L is done and dusted. Now let's move on to our balance sheet, guys. So in our balance sheet also, if you see, like there are like only a few items which you actually need to tackle. So one would be, so first would be property, plant, equipment, intangible assets. Next would be our working capital. In our working capital, what are the items that would come? Your inventories would come, accounts receivable would come, and your trade payables would come. So these are 3 items which we need to tackle on our working capital. So first, let's maybe tackle our working capital and then come back to property, plant, equipment. All right? Yeah. Moving on to our working capital, guys. So let's come to our working capital. So basically, guys, what we need to do is we need to first compute the number of days outstanding, days since outstanding. DSO is a common term which they use in industry. We need to compute this, guys. So after we compute this, I'll tell you what to do and why we do this, right? So first, let's compute the days since outstanding. So I think you'd have read this as a part of your ratio analysis. I'm not going into the logics. I'm not going to explain the interpretation of this. Maybe we can take that up in a separate video due to paucity of time. But okay, I'll just explain you the formula. So receivable days is equal to receivables by credit sales into 365. Why into 365? Because we are looking at this for the entire financial year. So receivable days is basically receivables by credit sales into 365. So let's just recompute this, guys. So our receivables are from balance sheet C24. So 60 crores divided by my P&L C7. So P&L C7, how do I get to P&L C7? Okay, so C7 may, I have revenue. So basically I've taken my trade receivables by revenue into 365. So we get an understanding from the management that all the sales are credit sales, there are no cash sales. So we have directly taken the revenue from operations number as a part of credit sales. I hope that is very clear, guys. And we multiply this with 365. And when we multiply this with 365, we get days of outstanding as 44. Okay, I've rounded it off to 45 just to ensure that it is, just to ensure for simplicity in calculation purposes. Similarly for inventory, I basically take my inventory divided by cost of goods sold into 365. So if you see here, inventory is basically linked to my P&L, balance sheet, and my cost of goods sold is basically the sum total of my cost of materials consumed, changes in inventory, and purchases of stock in trade. Oh, that is clear. And by doing so, we get a inventory days number of 60. And for payables, we take the trade payables in our financial statements divided by cost of goods sold in P&L and multiply it with 365. So we get 25 payable days. For simplicity, I've rounded it off to 30 days. And also, based on discussions with the management, we understand that recently, by looking at the purchase orders that the management has entered into for financial year 25-26, on an average, the credit period comes out to 30 days. So instead of 25, we have taken 30. It's not a big deviation, so we not bother too much about that. So we've taken a payable days of 30, we have taken inventory days of 60, we have taken receivable days of 45. Yep. So guys, so where does this come into play, guys? Very simple. We'll do a cross multiplication, guys. Basically, if I have to do a cross multiplication, what would I get here? Receivables equal to receivable days into credit sales. Inventory is equal to inventory days into COGS. Payable is equal to payable days into COGS. We got our receivable days, we got our inventory days, and we got our payable days. So we can cross multiply and we can get our receivables, inventory, and payable balance. That's what we're doing, right? Yes, sir. Yeah, that's it. So let's come here. So basically, for example, for receivables, if I have to explain for year 1, it's basically my receivable days into credit sales. So basically my projected P&L D7, it's linked here. So this is my sales into receivable days of 45, which they have taken here, multiplied and got the receivable numbers. Similarly for inventory, they have linked it to the cost of goods sold 440 here in the P&L, multiplied it with the inventory days. Similarly for payables, they have linked it to the cost of goods sold here and multiplied it, and they've got this number, right? So that's how they've got the number. I hope that is very clear, guys. Yep. So that's basically what's been done, guys. and we get the total number here. We get the total working capital for year 1, we get the total working capital for year 2, we get the total working capital for year 3, we get the total working capital for year 4, we get the total working capital for year 5. I hope that is very clear, guys. We got the total working capital for year 1, year 2, year 3, year 4, and year 5. So what is working capital, guys? It's the total of receivables and inventory minus payables, because working capital is basically current assets minus current liabilities. So we have done a deep analysis of working capital in one of our earlier videos. You can again check that out. I've attached the link of that in the description. That would be really useful for you. So basically, we've got the working capital numbers. So what do we do now? Basically, guys, let's find out the working capital as at March 31, 2025. Working capital as at March 31, 2025 would be my receivables as at March 31, 2025, inventory as at March 31, 2025, minus payables as at March 31, 2025, which is what we have basically taken here. C21 plus C24 minus C252, C21 plus C24. We get a number of 120 here, minus my trade payables 120 minus, let's just come down a bit, 120 minus 2595. Yes, that's the number we got here. Perfect. Yes, guys. And we had already discussed this in our cash flow video that if my working capital in year 2 is increasing as against year 1, it would be a negative sign. However, if my working capital in year 2 is decreasing as against year 1, it would be a positive sign. Again, the logic behind the negative sign and the positive sign you have discussed as a part of our cash flow video, guys. Again, if I initiate that discussion, that would take additional 10 minutes, which I don't want to do. Again, you can check that video out in the description, which I've attached below. So I hope that would be helpful. So if you see here, in year 1, it's 115, but in March 31, 2025, it's 95. So there is an increase of 20, which is a negative sign. Again, in year 2, there's an increase of 2, negative. Again, year 3, there's an increase of 12, which is negative. Year 4, there's an increase of 13, which is negative. Year 5, there's an increase of 14, which is negative, which is what you've taken here, guys. I hope that is very clear. Let's go to our balance sheet and let's ensure that all these numbers are linked perfectly, right? Let's ensure that a formula is given to all these numbers and nothing is manually keyed in for inventory, accounts receivable and payables. Inventory is linked. Perfect. Perfect, sir. Yes, sir. Done, sir. Let's ensure that our trade receivables are also linked. Yes, linked. Perfect. These are the numbers that were there also. You can verify the accuracy of the numbers. I've already verified them. You can also verify them once for your comfort. Next, let's just come down to trade payables. Trade payables again, guys, as I told you, no need to split between MSME and non-MSME because we're not looking at a Schedule 3 finances. We're looking at it from a projection standpoint. Again, it's linked. Perfect, sir. Yes. So our working capital is done, guys. Let's move to PPE, guys. Yeah, let's look at our Capex schedule workings. Just a moment, guys. Let's move to our Capex schedule and let's look at the workings, right? Sorry, just a moment. Hey guys, let's continue from where we left. So moving on, guys. So basically, let's move on to the Capex schedule, guys. How do we project for property, plant and equipment, intangible assets, and capital work in progress? So that's going to be our discussion right now. Since we got done with working capital, this is another major chunk that's left to be done. So guys, let's say you go to the PPE note and the intangible notes in the financial statements. So first of all, guys, let me just give you a brief understanding of this here. If I just come here, whatever number you're seeing in against PPE or intangible assets, this is the net block value. This is basically gross block value minus accumulated depreciation, which is the net block value, which is getting displayed here. I hope you are very, very clear about this, guys. So if I just come here, basically, so when I go to the PPE note in the financial statements, you will get to see what is the gross block value and what is the accumulated depreciation. Ideally, the gross block value minus accumulated depreciation should equal to the net block. And that is the check which we have done here, guys. Basically, we have taken the gross block from the notes. We don't have an actual FS here because this is something hypothetical. So I've given hypothetical numbers for the gross block and the accumulated depreciation. And ideally, the number which I'm deriving as net block should match with the financials, which is the sense check which we have done here, guys. You see, basically, we've taken the gross block value of PP and intangible assets, and we are saying that we are tracing it to the notes to accounts. And then we're taking the accumulated depreciation of 40 in relation to PP. In relation to intangible assets, it's 2 crores. And basically, guys, if I just come to the P&L here, I'm just coming to the P&L for a particular reason. You see that there is a depreciation amortization expense of 25. Out of this, I have stated that 24 is in relation to PP and 1 is in relation to intangible assets. Basically, if I just come here, out of this accumulated depreciation, 24 is from current year depreciation charge, which would basically mean that 16 would be the accumulated depreciation opening and 24 would be the current year depreciation charge. And similarly, for intangible assets, 1 would be the opening and 1 would be the current year depreciation charge. So the total accumulated depreciation value would be 42, thereby yielding a net block value of 507 minus 42, 465. And as for the financials, it comes out to 465. So the difference is 0. So the net block is tying out, no concerns at all. Now we will look at what is the percentage of depreciation to the gross block value. Why the gross block value, sir? Because the company is using SLM method of depreciation. And as you all know, here straight line method depreciation computes the depreciation as a percentage of the original cost, or basis the original cost. So what we are basically getting an understanding of is, if I basically take my depreciation charge for the year, we saw that 25 was the depreciation charge for the year, and divide by the gross block value, I'm getting a number of 5%, which is what we basically get here. So what I will do is, while projecting my property, plant and equipment block for the next 5 years, I will assume that my depreciation charge for that financial year is 5% of the gross block value. I hope that is clear, guys. So let's take the opening gross block value here. The opening gross block value should ideally be 507. But what have we done here? We've taken the CWIP number also here. You would have a doubt now. Sir, why can't we take 507 plus 20 here itself, sir? No, guys, we cannot do that. The reason being that when we are seeing depreciation as a percentage of gross block value, we should only be taking PP and intangible assets. We should not be taking CWIP, because CWIP is not subject to depreciation. When we are taking CWIP in the denominator, it does not give a right picture. That is why here we have taken only 507, but here we are adding the 20, because CWIP of the previous year, we are presuming that it will get capitalized in the subsequent year. That is the first year of projection in our case. That is what I'm saying. 20 of CWIP added, as the number of 507 did not include CWIP. Replacement capex would equal the previous year depreciation. Why is that, sir? Let me take a simple example. Let's say the cost of an asset is rupees 100. Let's say the useful life is 5 years. What would be the depreciation for each year? It would be 20. Let's say in the first year it is 20. So what would happen? My block value would be 100 minus 20, 80. What is happening here, sir? Next year at the end of year 1, 20 of value has been utilized. That is, the efficiency of the asset has been reduced to the extent of 20. Since the efficiency of the asset has been reduced to the extent of 20, I need to bring in an efficiency of 20 into the business, due to which I have to pump in another asset to the equivalent value of 20 in the business. So that is why what I'm trying to drive here or say is that your replacement capex number will equal to the depreciation charge of the previous year. I hope your understanding is very clear on this, guys. This is the logic behind that. So my replacement capex would be the depreciation charge of previous year, which I am linking back to my profit and loss account. I hope that is very clear. Next, when I come to my opening accumulated depreciation, I see that my opening accumulated depreciation is minus 42, which traces to the previous year. So basically my closing accumulated depreciation would be my opening accumulated depreciation and the depreciation of the current year added along with that. So if I take the depreciation of my current year, which is basically 5% of my gross block value, and the replacement capex. So I have to apply the depreciation on the replacement capex also, because that has been added in the current year, and depreciation is also required to be computed on that. So basically when I do 527 plus 25 into 5%. I'll just do that here quickly. Anyways, I've done that. So just do a sense check for you guys. I'm just doing this. When I apply 5% on this, we get a number of 27.6, which is what we have basically taken here. You might get a doubt like, sir, the replacement capex happens throughout the year, but why have you taken depreciation for the entire year? Guys, there is no hard and fast logic that I have to take it like 50% or 60%, or I can even take the entire depreciation, because ultimately, if you see, for the purpose of discounted cash flow method, we are going to be adding back the depreciation, because depreciation is a non-cash item. So ultimately, what impact of depreciation that flows into the discounted cash flow approach is basically the tax impact of depreciation. The depreciation number in itself does not impact the discounted cash flow workings, guys. Please keep that in mind. I hope you understood this, guys. So I can put any number for depreciation unless it is kind of reasonable. So that is perfectly fine. I hope you got this, guys. So the gross block value is 552. And my accumulated depreciation is 42 of opening plus 27 of current year depreciation, 69. My net block value is 483. And when I take my gross block value for the next year, it would be the closing gross block value of the last year, 552. I'm adding a replacement capex of last year depreciation charge of 27. My opening accumulated depreciation of 69. My current year depreciation would be basically 552 plus 27. That is opening gross block value plus replacement capex into 5%, which I'm getting here. And I'm getting a gross block value of 579, ACDAP of 98, and net block value of 481. Similarly, I do it for the rest of the 3 years and I get these numbers. And as I told you guys earlier, you have this Excel. I've attached it in the description and also in our Telegram group. You can check it out from there and you can do a sense check again if you want to. So this is how we basically derive the numbers, guys. And moving on to the linking, like how do we treat this in our balance sheet? Let's go to our balance sheet. And first, before we move to our balance sheet, as we had already discussed earlier, the only number that was pending to be filled in our P&L was the depreciation, which we have discussed now, which we have again linked to each of the numbers, 27, 29, 30, 31, 33. Perfect. Everything is being linked. Every single thing is being linked. So we are done and dusted with our P&L also, guys. That's it. Now coming to our balance sheet. In our balance sheet, let's see whether the linking has been done fine. 483, it's linked 483, 481, 480, 479, 477, 481, 480, 479, 477. Perfect, sir. It's been done and dusted perfectly. Yes. Perfect. So guys, one more thing I would want to add on here is there can also be additional capex that an entity can incur. In the sense, let's say an entity wants to increase operating capacity. In that scenario, over and above the replacement capex, there would be additional capex that would be carried out, which would appear as an addition. In our case, we are assuming that we don't have any additional capex. However, if there is any additional capex, you need to understand the rationale behind the number that is taken as additional capex, and you also need to factor in the depreciation in relation to that and take it in the block. I hope that is clear, guys. And again, if you want me to explain that in detail, you can comment down below and I will do a separate video covering that as well. So this is done, guys. So basically, if I just come here, 483, 481, 484, 479, 477, everything is linked perfectly. And as I told you earlier, guys, please don't look at the split, whether how much is PP, how much is intangible. We are looking at it from a projection standpoint and not a Schedule 3 standpoint. Please just keep that in mind. So this is done, guys. So all our numbers in the balance sheet are done, except one. What is that one number that is not yet done, sir? The retained earnings. Retained earnings is not yet done. So retained earnings, how do I derive retained earnings? Basically, retained earnings for any year would be my opening retained earnings plus profit. If it's a loss, minus loss. That's it. Very simple. So if I come to financial year 24-25 of ABC Limited's financial statements, which has already been audited, I understand that 513 is the opening retained earnings. On top of that, the P&L charge is added, and the P&L charge is 50. So 513 plus 50, 563. So when I start for the first year of projection, 563 would be my opening retained earnings. On top of that, I would need to add the profit for the first year of projection. So 563 plus 32, 595. And next 595 plus 36, 631. Next 631 plus 40, 671, 672. It's just rounding off. 671 is rounded off to 672. So that is how we get the numbers. And this is how we get our other equity number as well. I hope that is very clear, guys. So we are done and dusted with each of the numbers in the balance sheet and P&L. So right now, what remains is basically the preparation of the cash flow statement. And then we right away move on to the discounted cash flow workings, right? Yeah, just coming now. Just a minute. I'm just going to the cash flow workings. So cash flow workings. Let's prepare the cash flow statement for the 5 years of projections, guys. So just coming to the 5 years of projections. Just give me a moment, guys. Just give me a moment. Hey guys, so we would need to prepare the cash flow statement for the 5 years. Again, this is not a cash flow statement as per Ind AS 7. This is like an extract of a cash flow statement or a simplified cash flow statement, whatever you'd like to call it. So I start with my profit before tax of 43. Then I come to my add back my depreciation. Then I see that there is an increase in working capital every year, as we had discussed. We are again linking this to the working capital tab. Everything is linked here. Nothing is keyed in. This is also linked. 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 Perfect, sir. Yes, and capex, when I'm again linking it to the capex schedule. Whenever I'm incurring a capital expenditure, I'm spending money on it. So it's an outflow in the cash flow statement, which is again reflected here as a negative sign. I hope that is clear. And tax paid is again an outflow. So we are assuming that whatever is the current tax charge, the entity has paid it in the financial year itself, and there is no tax liability or tax asset in the balance sheet. I hope that is very clear. So we have directly linked it to the P&L number. And before that, guys, just want to tell you one thing. Whenever you complete the projected balance sheet, just ensure that the assets and liabilities side tie out perfectly and that the difference is zero. And in our case, the difference is zero, so we don't have any concerns surrounding that. So let me just come to the cash flow and impairment projections. So guys, if you see here, we got our cash flow for the year before taxes. We got the cash flow after taxes. You would have a doubt here, guys. Why am I writing two numbers, cash flow for the year before taxes and cash flow after taxes? First, let us discuss about cash flow after taxes. So we get the number cash flow after taxes. We get the number cash flow after taxes. We get the cash flow after taxes number here for all the 5 years of projections. What we are basically going to be doing is, we know that the opening cash for financial year 25-26, that is as at April 1, 2025, would be based on the closing of financial year 24-25. What is the closing cash for financial year 24-25? We can get this from here, which is the actual financial statements for 24-25 of ABC Limited, which comes out to 12. So basically 12 plus my cash flow after taxes would yield me the closing balance as at March 31, 2026. Similarly, as at March 31, 2027, my opening balance would be 27, which is the closing balance of the last year, plus my cash flow after taxes 35, because whatever money I pay whatever money is remaining after I pay off my taxes, that is the actual cash flow movement for the year, and I get my closing balance of 62, which is basically 35 plus 27. I hope that is again clear, guys. So we have understood why we have taken cash flow after taxes as a number. But why do we take cash flow before taxes as a number, guys? Very simple logic. Your Ind AS 36, your standard for impairment, clearly states that whenever you are discounting your cash flows, you should use the pre-tax discount rate. So think logically, guys. When you're using the pre-tax discount rate to discount cash flows, your cash flow should also be pre-tax, right? Obviously, because when the discount rate in itself is pre-tax, your cash flows also ought to be pre-tax. That is why we have taken cash flow for the year before taxes as the number here. If I just come down to my discounted cash flow working, and I show you the cash flow numbers, all these numbers are pre-tax, which I've taken here, 26, 47, 43, 48, 54. And we have taken a discounting factor of 12%. I'll explain the logic behind the 12%. And we have taken a growth rate of 3%. I will again explain the logic behind the 3%. For now, I'll just tell you how the computations been worked out. For now, focus on the 12% discount rate, 13%, 11%. We'll come back to that later. We'll discuss that in a while. So for now, just look at this. We have taken a discount rate of 12%. So present value is basically 1 divided by 1.12. For the second year, it would be 1 by 1.12 power 2. Third year 1 by 1.12 power 3, fourth year 1 by 1.12 power 4, fifth year 1 by 1.12 power 5, right? So on and so forth, and we multiply this and we arrive at the present value. For the terminal value, we use the Gordon's formula. What is the Gordon's formula? For year 5, it would basically be year 6 by WACC minus G. What is year 6? Year 6 is basically year 5 into 1 plus G, right? Perfect. Yes, sir. So year 5 ka cash flow before tax, we know that it is 54 before tax, into 1 plus growth rate into 1.03, which you applied. Like, let me just go to C51, give you a perspective where we have mentioned, link the growth rate number. C51 growth rate is 3%, which we have explained here, right? And when we do WACC minus G, WACC is 12% minus growth rate of 3%, we get a number of 9% here. So we take 55.42 by 9%, we get a terminal value of 615.73. Again, we need to take this to the present value. How do we take this to the present value? This is at the end of year 5. So we again take the year 5 present value factor of 0.567, multiply 615.73 with 0.567, and get a present value of 349.38. So the total value in use which we are getting is 501.54. You might have a doubt now, guys, as to why we are not computing fair value less cost of disposal. So we had a discussion with the management and we understood that they do not have an intention to dispose of the investment in ABC Limited. So since the fair value less cost of disposal is 0 and value in use is more than that, value in use is regarded as the recoverable amount for comparison with the carrying amount. I hope that is very clear. So we have a number of 501.54. But what is this 50 and 7, sir? You might have a doubt here, guys. Let me explain this to you. So basis our discussions with the management, we understood that actually there was an idle land in ABC's balance sheet. In the sense that this idle land, basically what happened was, this land was not used for any production purpose. This land was idle, which is why it is taken in the computation, because this land, since it is not used for any purposes, this is going to increase the enterprise value of ABC as an entity. And what happened is, if you come to the balance sheet of ABC Limited, you will see that there is a current investment of rupees 7 crores. Based on our discussions, we understand that these investments pertain to investments in mutual funds, which are highly liquid in nature. And again, we take this in the enterprise value computation. The reason being that this is a current asset, and we have not taken it in the working capital computation. So since it has not been considered in the working capital computation, and since it is a surplus asset, it is obviously going to increase the value in use and the enterprise value as a whole, which is why we are adding it here. I hope it is very clear, guys. If you add all this together, you get a number of 559, but we have a number of 530.61. So what is this, sir? This is mathematically inaccurate. There is some formula mistake. No, guys, there is no formula mistake. We have taken the correct formula. We have multiplied with 0.95. Why 0.95, sir? Just rewind a bit. Go back to the start of our discussion. I told you something that was really important. XYZ Limited holds a stake of only 95% in ABC Limited. ABC Limited is not a wholly owned subsidiary of XYZ Limited. I hope you remember that we discussed this, guys. And if you see the carrying amount of XYZ's investment in ABC Limited, it is 300 crores. So since the value in use significantly exceeds the carrying amount, we have sufficient headroom, guys, of 230.61 crores. Okay, guys. So we as KPMG, we have done and dusted this. Okay, now let's look at this perspective. Let us say PwC were the auditors of ABC Limited, as we had already discussed. Let us say what PwC will be doing is, let's say PwC assess and understand that, okay, the company as a whole is a single CGU. They don't have separate CGUs. So what would happen is, let's say they find out the value in use is 558.54, because at the standalone financial statements, when PwC are doing the computation for ABC as a whole, they won't do 0.95, right? Because it is for the entity as a whole. So when they will basically take the total of all these three together, 558.54, which you have got here, they will take this. But for carrying amount comparison, what will they take as the carrying amount? Basically, for the comparison of carrying amount, auditors, that is PwC or the management of ABC Limited, for their standalone financial statements, for their impairment assessment, what they will be taking is, they will be taking the carrying amount of PPE, ROU assets and CWIP. So basically, let us say the PPE, CWIP and ROU comes to 150 crores. You'll see that the headroom is 408.54 crores. It is significantly higher. So guys, if you see here, the headroom is more. Why is the headroom more, sir? Because the PPE value, the ROU value is subject to depreciation. But the investment carrying amount of 300 crores is not subject to depreciation. It is only and only subject to impairment. So what would happen is the gross block would have been way higher than this, but since it got depreciated year on year, the carrying amount got reduced substantially, and the headroom is significantly higher here. So in practical cases, what happens is there could be a scenario where at the standalone level, the headroom might be really high, but while doing the impairment assessment for the investment, there could be an impairment number itself that is arising due to the lesser headroom or no headroom. In this case, we have a lesser headroom luckily, and we don't need to take an impairment charge. But there could be a scenario where there could be an impairment on the investment that is arising, but at the standalone level of that particular entity, there could be no impairment because of the fact that the carrying amount is substantially low due to depreciation charged on PPE. I hope you got an understanding of this, guys. So if you see here, like this would have been a new point for most of you. Most of you would have thought that okay, for at the investment level also the impairment computation is going to be the same. At the standalone level also the computation is going to be same. No, it's not going to be the same. There is going to be a substantial difference. The only thing that is going to remain constant is the value in use, and the only thing that is going to differ is the carrying amount. I hope you got an understanding about this, guys. Yep. Now let's discuss about the important things. Two important things: terminal growth rate and weighted average cost of capital. So weighted average cost of capital, what is it basically? It is basically my cost of equity into proportion of equity and my cost of debt into my proportion of debt in the capital structure. Am I right? Yes, sir. If you remember, we looked at the financials of ABC Limited and we saw that there was no debt, there was no finance cost. And based on our discussions with ABC Limited management also, we come to a conclusion that ABC Limited is not planning to raise any debt in the foreseeable future. And in the industry in which ABC Limited operates, raising debt is actually not the norm. So we come to a conclusion that cost of debt is zero. So we then conclude that weighted average cost of capital and cost of equity are going to be the same, right? So let's compute the cost of equity using the capital asset pricing model. Capital asset pricing model, what's the formula? The formula for capital asset pricing model is basically KE is equal to RF, which is the risk-free rate, plus RM minus RF, which is market return minus risk-free rate into beta. So how do we get the risk-free rate? Let's say we look at a site like investing.com, and let's say we get the 5-year government of India bond rate from investing.com, and let's say that comes out to 7%. So these are hypothetical numbers, guys. These are not accurate numbers. If I have to show you the accurate numbers, it will take a lot of time. So I'm not doing that exercise now. But if you want me, you can reach out to me personally, and I'll tell you how to check it practically. The risk-free rate is 7%, and let's say the Sensex or the Nifty on an average provides a return of 13%, which we can again go up and look at the historical data and get this number. So the market return is 13%. The risk premium would be 13% minus 7%, 6%, and beta would be 0.85. So how do we compute the cost of equity here? It would basically be RF, which is 7%, plus RM minus RF. So RM minus RF comes to 6%. So 7 plus 6 into 0.85. So that is how we get a number of 12% here, which is basically our cost of equity, which in turn equals our weighted average cost of capital, since we don't have debt in the capital structure. I hope that's clear. So this is what we arrive at as the weighted average cost of capital. Now let's look at the terminal growth rate. So basis the real GDP growth that's been observed, we see that it comes around 6%. But what Ind AS 36 says is that your terminal growth rate shall not exceed the long-term growth rate of the market. So what we are doing as auditors is, and what the management also feels is that, okay, growth of 6% is there in the economy, that is true, but in an industry, achieving that growth is very tough. So what we'll do is we can maybe look at a growth of 3% on an average. So the management feels that, okay, we'll take a growth rate of 3%, not 6%, because 6% is for the economy as a whole, but us achieving 6% is kind of unrealistic. So let's go with 3%. So we take a growth rate of 3%. So that is how we apply the terminal growth rate here, and we get that number. I hope that is very, very clear, guys. Yep. Now let us look at another important concept, guys. This concept is called sensitivity, and with this we'll almost be done, and there'll be a couple of other add-ons which we need to be discussing, which we'll discuss. So just give me a moment, guys. Just a moment. Sorry, just a moment. Hey guys, let's resume with sensitivity. So in sensitivity, we're going to be looking at the sensitivity of two main factors. First would be the weighted average cost of capital, and the next would be the growth rate. So in the first case, we are going to be assuming that the weighted average cost of capital increases by 1% and also decreases by 1% with the growth rate remaining constant. And in the second scenario, we're going to be assuming that the growth rate increases by 1% and decreases by 1% with the weighted average cost of capital remaining constant at 12%. And in the third scenario, this is the worst case scenario, which would lead to a significant reduction in value in use, wherein we are going to be assuming that the weighted average cost of capital increases by 1% and the growth rate decreases by 1%. So in the third scenario, we're going to be assuming a change in both of the variables, which would be the worst case scenario, which would be the most adverse impact. So in the first case scenario, I'll explain you number by number how we do this, and you'll be able to do the same for the other two scenarios. And in case you have a doubt, do reach out to me. I'll clarify you how it is done, and you also have the Excel with you. You can have a look into it. So in the first case scenario, we are assuming that first the weighted average cost of capital becomes 13% and the growth rate remains at 3%. How do we compute this? Let's go to our cash flow and impairment working tab. So first we took the discount factor at 13%. We did 1 by 1.13, 1 by 1.13 power 2, 1 by 1.13 power 3, 1 by 1.13 power 4, and 1 by 1.3 power 5. And for the terminal value also, it would be 1 by 1.13 power 5. And at 13% back, we tried deriving the terminal value, which would basically be 55.42 in the numerator divided by 13% of WACC minus 3% of growth rate, 10%. So which would yield a terminal value of 554.16, but this would be at the end of year 5. So we would need to convert this into present value terms. How do they convert this into present value terms? 554.16 into 0.543, it comes to 300.77537. So if you're able to see here, the value in use is coming to 448.86. If I just come here, plus my idle land of 50, plus my short-term investments that are marketable, similar to this, I get a total of 505.86. And when I apply 95%, I get 480.57. So guys, if you see here, when I take a higher WACC, my value in use is reducing. Why is the reason my value in use is reducing? The simple reason being that we are dividing the denominator by a higher number when we take the WACC, because we are doing a discounting by taking the WACC in the denominator. And when we take a higher number in the denominator, the ultimate result gets reduced. This is simple basic mathematics. And this is the basic of present value. And I hope you all are familiar with this logic. So that is why we get a lesser value in use in this case. However, if you look at the reverse case where I take a WACC of 11%, I get 55.42 in the numerator. Just a moment. Sorry. Yeah, I get a WACC of, I get a number of 55.42 in the numerator, and in the denominator it becomes 11% minus 3%, 8%, and my terminal value goes up to 692.70. And when I multiply that with my present value factor, it comes to 411.0831 here. And my total present value by doing discounting at the rate of 11% comes to 567.47. And when I take the value of my idle land and my short-term investments, it comes to 624.47, on which if I apply a percentage of 95%, it would come to 593.25. And if you see, the headroom is highest in this case. Why is it highest in the case? Because in the denominator, I'm taking a lower present value factor or a lower weighted average cost of capital, which is leading to a higher result. I hope that is very clear, guys. This was the first case scenario. Similarly, in relation to growth, when the growth rate increases, the value in use increases. So growth rate and value in use are directly proportional, whereas my weighted average cost of capital and my value in use are inversely proportional. I hope that is very clear. So this is how for the second scenario. Similarly, if you look at the workings, you will get to know how I substituted and you will get an understanding. Maybe I'll just show you quickly. If you see here, when we take a growth rate of 4%, the value in use comes to 575.72. However, when we take a growth rate of 2%, the value in use comes to 494.52. I hope you got this. I hope you got this, guys. And similarly, when I come to the last scenario where my WACC is 13% and my growth rate is 2%, this is the most adverse scenario. So in this scenario, what is happening is we are getting a value in use of 452.07. Let's look at the other cases value in uses. So in the other cases, the value in use is above the last case. So the last case is the worst case scenario because we are taking a very high WACC, which is going to downgrade my value in use, and a very, very low growth rate, which is again going to downgrade my value in use. So two factors are pushing down the value in use, leading to a lower value in use ultimately. I hope that is very clear, guys. Again, for this, we have done the computation, we've done the linking again. Due to paucity of time, I don't want to be explaining this one by one. This is just mathematics. If you look at the formula, you will get a good understanding. And despite this, if you don't get a good understanding, do reach out to me. I will definitely explain to you how we arrived at this, right? Yeah. So this is how we basically do sensitivity, guys. First of all, why is it important to do sensitivity, sir? Why can't? Because every single number which we saw was subject to an assumption, was subject to professional judgment. So if the number changes by bit, by even a slight percentage or a slight margin, look at the impact. Like for example, look at the headroom in this case, it's 152 crores. But look at the headroom in this case, it's 293 crores. We just made a slight change in the percentage. But even after a slight change in percentage, the impact on the headroom is significant. That is why we do something called sensitivity analysis. And luckily for us, after doing the sensitivity analysis for each of the possible scenarios, and even in the worst case scenario, we had a very good headroom, due to which an impairment charge is not required in the books of accounts. So the reason behind doing sensitivity is there is no one hard and fast number that should be taken as the discount rate, or there is no one hard and fast number that should be taken as the growth rate. So because all these numbers are subject to assumption and professional judgment. So if there is a case where the headroom goes off completely and it leads to an impairment scenario, then we need to discuss further. Then we need to evaluate whether what we are doing in the first place is even right or not. That is why we do a sensitivity to get an understanding of the probable ranges within which the value news is expected to lie and the headroom is expected to be in, to get a better understanding of various possible outcomes. I hope that is very clear, guys. So this is it, guys. So after this, we have something which we would be discussing. We have two things. First, let's go to our base sheet where we design our work paper. So in the sheet, what basically we have done is we have taken various paragraphs from Ind AS 36, a bad text, and we are assessing the same in the context of our client. So basically, this is just the intro which I explained here, which is in the technical language of the standard. I'm not going to read this line by line because I'm sure you guys would have read Ind AS 36, but I will just explain you a gist of the points here. Like for example, paragraph 12 is asking whether the asset value has declined significantly, or whether there is any technological, economic, or market or legal impact that has affected the entity as a trigger for impairment. In our case, as we had earlier discussed, in relation to ABC Limited, there was no such trigger due to which we proceeded with an impairment testing. The next set of questions it is asking us is whether there is an evidence of obsolescence or physical damage, whether there is any adverse effect that has taken place on ABC Limited or is expected to take place in the future, or whether the net worth of ABC Limited is negative. Is the net worth of ABC Limited negative? No, sir, it's not negative. If you see here, it is 613, it is positive. 613 crores, it is positive. So these are also not the triggers for impairment. But if you come to the next set of points, basically in paragraph 14, it is saying whether the cash flows are significantly higher than those originally budgeted for acquiring the asset. This is also not applicable because this is an investment. This point A in 14 paragraph is from a property plant equivalent perspective, or whether the actual net cash flows or operating profit or loss flowing from the asset are significantly worse than those budgeted. So this is the reason actually. So I did not reveal this reason to you because if I had revealed this reason to you, you wouldn't be listening to all the possible reasons that I'm discussing right now. So basically the reason why we first went for an impairment testing was because the trigger was that they had forecasted a higher cash flow, but they ended up getting a lower cash flow. So they had to reevaluate whether there existed an impairment charge in reality or not. And luckily, even though there was a trigger for impairment, after doing the impairment testing, we concluded that an impairment charge was not required to be taken in the books of accounts. So that is what we have concluded. So if you see here, we have responded saying, based on our discussions with the management, we understood that the actual cash flow and operating profit are significantly worse than budgeted. Hence, there exists an internal indicator of impairment on account of which management has done an assessment whose reasonableness we have evaluated as independent auditors. Yes, that's what we are responding here. In measuring value news, so basically this point is saying that in measuring value news, the assumptions should be that are to be used should be reasonable and supportable, and more weight should be given to external evidence. Let us say, as per an external report, it says that the market size is 50 million units, but the entity says that the market size is 100 million units. You need to rely on the external report because that is a more reliable evidence, and that is what Ind AS 36 is trying to convey here. And another important, very, very important point which Ind AS 36 tells you is that your projections should be for a maximum period of 5 years using discounted cash flow approach. And if you're using a period more than 5 years, then you need to provide a valid justification. In our audit clients which we have looked into, we have not seen a case wherein the client has projected for more than 5 years. It is usually a period of 3 years for which the projections are done, or a period of 5 years for which projections are done. Because let's be practical, guys. Even the next year projections are not like going to be exactly happening in reality. Because, for example, in 2019, no one even expected something like COVID to strike in 2020. So even when the next year is uncertain, how can someone project for more than 5 years? That is really, really unrealistic. So because a lot of things can change, a lot of developments can happen in a period of 5 years, and 5 years in itself is a too long period, is what I feel. So that's what I'm trying to convey here, and that is what the standard is also asking. And another thing which the standard is asking is that the growth rate which the entity is taking for the purpose of terminal growth should not exceed the growth rate of the economy as a whole, which we already ensured as a part of our sense check when we are doing that. Next, it is saying that the discount rate should be pre-tax rate, which we already ensured that it is a pre-tax rate. And it should and what it is saying is that you should take the asset specific rate. Let's say there is an asset for which you have a specific rate of interest or rate of return. That rate should be the first preference for discounting. If that is not available, you have to arrive at an appropriate discount rate. Since a particular asset specific rate is not available for discounting in our case, we arrived at the discount rate using the capital asset pricing model. I hope that is very clear, guys. So that's what you have written, saying that since a specific rate was not available, we use the discounted cash flow approach and we found out the discount rate using the capital asset pricing model. I hope that is very clear. Next. So basically, it says that your recoverable amount is going to be your fair value less cost of disposal or value in use, whichever is higher. And as we had already discussed, the management does not have any intention to dispose the stake in ABC Limited. So the value in use is going to be higher than the recoverable amount. Than the fair value less cost of disposal, because fair value less cost of disposal in this example is 0. I hope that is very clear. And another important point, guys, I just wanted to convey that. Just give me a moment. Sorry, just a moment. Yes, guys, from a practical standpoint, there is something called Appendix A. So what in Ind AS 36, what that states is that let us say your entity is operating in an uncertain environment. Let's say you're doing the cash flow projections for an entity like a startup, or an entity that is in its declining phase, or an entity that is burning cash like anything. In that case, what the standard is saying is you should give impact for this either in the discount rate or in the cash flow. Like you have to give a higher discount rate for the discounting purpose, or you have to give lower cash flows. Don't do both. Like what will happen is if you're taking a higher discounting rate and very, very conservative cash flows, what would happen is your value in use would get significantly reduced, and it would definitely lead to an impairment scenario. But what Ind AS 36 Appendix A is saying is that it tells you that just be conservative on one of these things. Don't be conservative on both of these things, because if you're going to be conservative on both of these things, you're more likely than not to take an impairment charge. So in summary, this is what your Appendix A states, just to give you an understanding. So what entities do in practice is, in case where the entity is in a highly volatile environment, they either take the cash flows in a very, very conservative way, or they take a very high discounting rate. They don't do both of these. So this is just to give you an understanding, guys. I hope this is clear, right? So work done. So work done is basically the work which we have done surrounding this, which we said that we have obtained this information from the management. We have also assessed the reasonableness of the assumptions. We have ensured the balance sheet is netting off to zero. We have ensured that the pre-tax discount rate was used. We've also discussed with the management. We also discussed with PwC, who are the auditors of ABC Limited. We also discussed with the CFO of ABC Limited, Mr. Arvind. I've just mentioned my name there. And based on the work performed, we note no concerns and there is no impairment charge required. This is what we are documenting. That's it, guys. And now we are just left with two more aspects. So recently, NFRA, National Financial Reporting Authority, came up with a circular in relation to impairment. That is one thing which we are left to discuss with. And another thing is in valuation team comments. What is valuation memorandum, guys? Basically, what happens is, if you all read two standards, I'm going to reference two standards here: SA 500, SA 620. SA 500 is a standard about audit evidence. SA 620 is about auditor's expert. So in SA 500, there is a term called management expert that has been defined. And in SA 620, auditor's expert is spoken about. So management expert refers to a person who assists the entity in the preparation of financial statements by providing expert guidance in a field other than audit and accounting. Like for example, an actuary is a management expert, a valuer is a management expert. Like for example, let us say the entity does not have a person who's experienced enough to prepare the discounted cash flow approach. They might take the help of a valuer entity who would assist the entity in preparing the discounted cash flow model by taking the growth rate, discount rate, and by computing the weighted average cost of capital. So that would be a management expert. What is auditor's expert? So auditor's expert, guys, can either be a person within the firm of the audit. Like in our example, since we belong to KPMG as per our example, it could be someone within KPMG or a part of KPMG's network firms, or even temporary staff of KPMG network firms, or even someone outside the firm whom we regard as an auditor's expert. So basically, auditor's expert will assist the auditor in a field other than accounting and audit to obtain sufficient appropriate audit evidence in the context of an audit. So here, what will the auditor's expert exactly do, and why do we go for an auditor's expert? Guys, if you see here, we are experts in audit and accounting, no doubt about that. But when it comes to a field like financial management, or when it comes to something like a discount rate or growth rate, yes, we have good working knowledge of it, but we are not experts in that field. So what we do is that we go to the experts, we ask them, sir, is this growth rate reasonable? Is this discount rate reasonable? Please evaluate us and please evaluate the same and provide us an opinion on the same, because you are the experts in the field. So we go to the people in the valuation team. So what would happen is we also enter into a scope of work agreement with the people in the valuation team. We tell them that this is the scope of work we are agreeing. You would have to provide us comfort on the discount rate and the growth rate by stating whether it is reasonable or not, because we are not experts in that field. So and we will say that we will take care of our numbers, we will take care of the accuracy, but you have to provide us comfort on the assumptions that are used. That is what we will request from the valuation team, and we will agree a scope of work. We will also obtain independence confirmation from them. And what will happen is basically the valuation team, after going through the workings which the management has given to us, will tell us whether the same is reasonable or not. They will also give some scope outs. In the sense, for example, they will say that we are not verifying the accuracy of the numbers. They will say that we are not verifying the projections. Like for example, they cannot verify revenue and COGS projections, right? Because they don't know the entity ABC Limited. Only you know the entity ABC Limited better than them, because you're there right at the field level, but they're not there right at the field level. I hope that is very clear, guys. So let's just look at some of the points which the valuation team usually gives. Like for example, we've been engaged to assist in reviewing the impairment assessment, and our scope work was limited to reviewing the valuation methodology adopted by the management, assessing the reasonableness of key assumptions, providing valuation related observations. So, and they've given a caveat here. So whatever is a caveat, I've highlighted that in red. So we need to dispose of these caveats, because we need to ensure at the end of the day that if something is not cleared by the valuation team, we are getting comfort over it on our own. by performing audit procedures. That is the whole purpose of it. Because tomorrow, if a regulator comes up and picks the file and asks question on where the audit procedure has been performed, and if we don't offer an answer to it, it's going to lead to serious repercussions. Because we need to have comfort over the numbers ultimately as statutory auditors, because we are going to be signing that audit report, not anyone else, right? So this is a disclaimer. We have not performed an independent valuation, nor have we audited or verified the underlying financial information. Like what they're saying is we have not audited the numbers, like the accuracy of the numbers in financial year 24-25. So that is what they're saying. So what we are responding is we have performed an independent valuation and have audited and verified the underlying financial information. Then the asset tested for impairment is the investment in equity shares, which is a long-term strategic investment. Management assesses the recoverable amount in accordance with Ind AS 36 practices, and we agree with the same, and we have ensured the same. This is factual. So what would happen is in the memo there would be a lot of factual points, and there would also be a lot of disclaimer points. So the factual points we will simply say that we agree and we align with the same, or we acknowledge the same, and move on. And for the disclaimer points, we'll dispose of by saying what procedures we have done from our end. Right? I hope that is very clear. Management determined the recoverable amount using the value and use approach. Right? Over a 5-year explicit forecast period together with terminal value. Cash flows are prepared on pre-tax basis. Correct. What they're saying is right. Discount rate is applied on a pre-tax basis, and terminal values estimated using Gordon model. Yes, perfect. We agree with the same. And the cash flows are not limited to dividend projections. Cash flows are prepared on going concern basis. Correct. Working capital movements are incorporated in the free cash flow computation. Yes, they are incorporated. Perfect. Yes, we have done that. Then pre-tax discount rate is appropriate. They have concluded that it is appropriate. Then how did they conclude? They have seen the risk-free rate. They have reviewed the equity risk premium. They have compared the beta and capital structure with comparable entities. Then they have come to a conclusion that okay, the discount rate applied falls within the reasonable range. Because like basically what they would have done is they would have taken the beta for the other listed companies in the similar industry. They would have taken the average beta of that and ensure that whether it is coming close to 0.85 or not, whatever we took in the computation. Then they are saying the terminal growth rate is also reasonable, and that is what we are also saying. We are in agreement with the same because we also found it to be reasonable. Next, the comparison of the recoverable amount with the carrying amount of the investment remains the responsibility of the management and the statutory audit team. So what they are saying is to ultimately conclude whether there is an impairment required or not, you need to compare the carrying amount and the value in use. We will not do that for you. That's what they're trying to say. Then management has performed sensitivity analysis, and yes, that we also performed that. We also verified that. So we are fine with that. Limitations and caveats. This is something which we need to be really careful about. The valuation memorandum has been prepared solely for use with the statutory audit team of company XYZ. Yes, that is what we are also saying. Yes, this has been used only with the statutory audit team of company XYZ. Does not constitute an audit or an independent valuation opinion. Yes, engagement team is aware of the same. Engagement team has performed an independent valuation and have audited and verified the underlying financial information of company ABC. Yes, we have done that. Yeah. Next, relies on information and assumptions provided by the management of company ABC, which has not been independently verified. ET has independently verified the numbers with respect to company ABC, because we would go back and check the financial statements of company ABC for the accuracy of the numbers. We would also discuss with the management of company ABC on the numbers taken in the projections, right? That is what they are referring to. Next, should not be distributed or relied upon by any third party. We acknowledge that we will not distribute it to any third party. That is what we stated in point D. Point E, actual results may differ materially from those projected due to changes in economic, market, or operational conditions. For which we have responded saying we acknowledge the same. We have also ensured by understanding the fact that management assumptions factor in the same. This has also been verified from independent third-party publications. Another important thing which I did not include here is the valuation team will ask you to get some points in your letter of representation as per SA 580. So when you are getting a letter of representation from the management, please ensure that those points which your valuation team is requesting you to get from the management are also included in your letter of representation. And the management signs the same by including the same in the letter of representation. I hope that is very clear, guys. This is something important you need to check, right? Cheers. Next, let's come to NFRA Circular, guys. So recently NFRA came up with a circular for impairment testing. So the first 6 pages of the circular were focused on Ind AS 36 technical parts, which I'm sure most of you would be aware if you've prepared for your CA finals. So that you can just give it a quick read. That's not anything that's like significantly new there. From page 7, you can start reading because page 7 is more from a practical audit context. So again, I will attach that circular in the description, which you can read. So I've made a brief summary of the things that we kept in mind. So what it is basically saying is the auditor has to fulfill the requirements of SA 540, SA 315, and SA 330. SA 540 is basically audit of accounting estimates, fair value estimates, and related disclosures. So the auditor has to ensure that estimates, that is whatever estimates the management has taken, like video discount rate or video growth rate, are reasonable, and we get comfort over the same, and whether the disclosures are in line with Ind AS 36. And SA 315 is risk assessment through understanding entity and its environment, whether the auditor has considered impairment for risk assessment, like auditor has done a preliminary risk assessment in relation to impairment, documented the risk assessment, brought in significant controls, like done a control testing around the controls for impairment, and the procedures done in relation to impairment. Like for example, this work paper outlines the procedures that we have carried out in relation to impairment. This work paper contains a test of details. For test of controls also, we need to complete a work paper in relation to impairment. Like we need to perform the control. we need to look at the signatures by the management. We need to look at the delegation of authority and whether the impairment workings have been sufficiently reviewed and approved by the management, and whether operating effectiveness is there surrounding that. We need to ensure that, and whether the same was identified as significant risk by the auditor. Why is it a significant risk, guys? Because as we earlier saw, even a small change in percentage or even a small change in any assumption could trigger a big number impact. So this is a significant risk, as it is going to be impacting our profit and loss account, and that is why you should treat this with a lot of attention. And usually this should be assigned to people who are experienced in the audit context, and that is why they take this area up. Then whether there are internal controls over the same, you need to ensure whether there are internal controls over the same and whether they are operating effectively. And you need to like observe the controls, or you need to inspect the control documentation in relation to the same and do the procedures surrounding that. And use of management experts, like whether if the management has used a valuer for the discounted cash flow model computation, you need to assess the competence of the expert and whether the expert is objective and independent of the entity. You need to document that the expert has good and rich experience in this field. And similarly for auditors expert also, you need to do this, saying that so and so people have been involved in the valuation clearance, and they have sufficient experience. They are also qualified CAs. They also completed their CFA, and they have good working knowledge around the industry. They have so and so years of experience, and they've been doing this day in and day out. And you need to document the competence in a professional way. That is something you need to do again. And whether auditors expert was used, yes, we use our auditors expert in-house within our firm. And whether disclosures are in line with Ind AS statistics. For this, I will show you a sample annual report where they have given the disclosures, which you can see. Next, evaluate 5 years projections in previous year also. For example, like what they are saying is, let's say in financial year 23-24 also, if you had done impairment testing, like you would have done the projections for 24-25, 25-26, 26-27, 27-28, and 28-29, right? So what they're saying is, in financial year 24-25, when you come to financial year 24-25, whatever you have projected in 23-24 for 24-25, compare that with in the current year, whether that is happening to an extent or not. Like let's say in 23-24, you had projected a revenue of 100 in 24-25, but in 24-25, actually the revenue is only 60. You need to understand why is that a very big gap, and then you need to evaluate this impact on the remaining years projected as well, as to whether an understatement in the projection is required, like whether you need to downgrade the projections and whether you need to reduce the value in use. So this is something which you need to compare with the previous year work paper also. This is of great relevance. This is very important, which you need to be doing, guys. Next, whether a key audit matter paragraph in accordance with SA 701 was used in the report. If not, why it wasn't given? Because as I told you earlier, guys, this is going to have a big number impact on your profit and loss account, and every user would be interested in knowing how the management went about this and how the auditor went about this, what procedures the auditor performed. So this is of great importance. Next, whether the management determined fair value truly represents the fair value required under Ind AS 113 and is not affected by conditions like transaction with related party, transaction under duress, or for sale, or the unit of account is different from the unit of account used for fair value measurement. So what they're basically saying is, in our case, this is not applicable because we are not intending to sell the investment. But let's say you had an intention to sell the investment. In that case, you need to see whether the fair value arrived is unbiased and is in line with the open market. In the sense, let's say in the open market, the fair value is like 90, but let's say your related party offers you 100. You can't say that the fair value is 100. The fair value is ideally 90 because you need to look at the open market value. So it should be unbiased, and you should be taking the real market value. That is what they're trying to say here. In case you're looking at fair value less cost of disposal also as a part of the recoverable amount computation. I hope that is very clear. Okay, let's read up this key audit matters report from a real life audit report of a listed company. Key audit matters are those matters that in our professional judgment were of more significance in our audit of the standalone Ind AS financial statements of the current period. These matters were addressed in the context of our audit of the standalone Ind AS financial statements as a whole, and informing our opinion thereon, we do not provide a separate opinion on these matters. Assessment of carrying value of investment in PSRIPL wholly owned subsidiary. As of March 31, 2025, the company has equity investments of 5060 lakhs in PSRIPL after considering impairment provision of 53,311 lakhs. So this impairment provision is cumulative, in the sense this would be the summation of financial year 21-22, 22-23, 23-24, and 24-25, right? So this would be the summation of everything. Like this is basically the balance sheet number till date number. I hope that is very clear. Next, we consider the assessment of carrying value of investment PSRIPL as a key audit matter, considering its significance to the standalone Ind AS financial statements. The judgment involved in estimating future cash flows, particularly with respect to factors such as discount rate, cash flow projections, and terminal growth rate. We'll see how the auditor has addressed the key audit matter. Our audit procedures included the following: understood and performed procedures to assess the design and testing the operating effectiveness of relevant controls related to assessment of carrying value of the investment, obtained the audited financial statements of PSRIPL and tested the company's management assessment with regard to key financial indicators, including net worth of PSRIPL with carrying value of the investment made in the entity. So the second point was not applicable for us because we had a positive net worth in our case of ABC Limited, so we didn't have any concerns there. Assessed the impairment testing model and evaluated the independence, competence, capabilities, and objectivity of the management expert, which we had already discussed. evaluated the reasonableness of the cash flow projections by checking the mathematical accuracy, discussing with the management to understand the assumptions involved, and our knowledge and understanding of the current business conditions, comparison with approved budgets. Yes, so we need to get an understanding of the business. We need to get comfort over the accuracy of the numbers, reasonableness of the projections, and all that, which we are already done, which we already discussed. Obtain the management's valuation supported by an independent report of its expert. So management expert's report is required to be obtained, evaluated along with the auditor's expert. Yes, we looked at our internal auditor's expert. We sent the workings to them. We also gave a reasonableness around the key assumptions. They also stated that the assumptions were reasonable, such as discount rate and growth rate. Perform sensitivity tests on the model. Yes, we did that. Read the subsidiary financial statements and auditors reports and discuss with the auditor of the subsidiary. Yes, we discussed with PwC, who were the auditors of ABC Limited in our case. We did that. We evaluated the adequacy of the disclosures made in the standalone Ind AS financial statements. Yes, I'll show you the disclosure again for the same company. You'll get an understanding. Note 43. The carrying value of the investments is more than the net worth of subsidiary, which is an indicator of potential impairment. But however, the indicator for us was different in our case, in the sense that the results were not as well as we expected. The results were adverse from that we expected. The company has performed a detailed impairment assessment, and based on the assessment performed, impairment was recognized during the year ended March 31, 2025, amounting to rupees 42,715 lakhs. This is the current year P&L charge. This is not the cumulative number. Please keep that in mind. So this number will impact your profit and loss for the current year. If you see here, they are saying carrying value before impairment is 47,775, recoverable amount is 5060, impairment charge is 42,715. So recoverable amount, value in use, because again, I think even they did not have an intention to dispose of the investment, which is why they have not taken fair value less cost of disposal. Valuation technique, discounted cash flow method. Key assumptions used: discount rate 9.5%, terminal growth rate 2%, spread, sales value, utilization of plant capacity. So here also they've stated the assumptions, what is the percentage of discount rate, what is the growth rate percentage, and they've stated that here for the users to get an understanding. I hope this is clear, guys. So that's it. We come to the end of this video. I hope you found this video really insightful. Guys, a lot of effort has gone into the designing of this work paper. A lot of effort has gone into shooting of this video. Please do support this. Please do comment down below, and please do share it to anyone who would need this. Even if it is your seniors, it would be really helpful for them, because this is a very technical area which only experienced people get to do in an audit. If you get to do this area, consider yourself lucky. So I passed on whatever I've learned during my articleship tenure while doing this area. So please do share this with your friends and your seniors as well. So keep learning, keep growing, and do check out the Excel work paper and do try understanding it. And if you found it really useful, please do recommend our channel to your friends. Thank you so much. Cheers. Take care. Goodbye. Thank you.